Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is September 1, welcome autumn, and this is a weekly markets update. Let's have a look at the news of week 35 and see what are the next trends. Please check out my interview with Victor Katso, managing partner of Venda na Hora Certa, that was published last week. Victor shared his view regarding current status and prospects of Brazilian market in front of the key purchasing season, so don't miss the jazz. Urea market held its breath in front of the Indian tender tomorrow. Last week, spot activity was subdued almost everywhere. Producers were trying to maintain the price level, while buyers were cautiously waiting. The whole market waits for the signal, which will appear after finalization of the tender. Meanwhile, this limbo state pushed prices down. Key questions that will affect market situation until the end of the year and magnitude of price correction are still unanswered. First one is related to the impact of Chinese supply to the Indian tender. How much China will supply? This mystery seems to be not revealed until the tender finalization. The upcoming meeting of Indian Prime Minister Modi and Chinese leader Xi Jinping this week might also shed light at the outcome. The second question is how many more Indian tenders the market will see until the end of the year. If this tender tomorrow is finalized with about 2 million tons of supply, India perhaps will need around 1.5 to 2 million tons to secure its inventories until January. So, in this case, one tender can cover this. However, there is also another option. Taking into account that this year urea supply hiccuped several times due to unsuccessful tenders because of various reasons, Indian farmers seem to be very unhappy with the government in this respect. We have seen farmer strikes amid urea deficit in certain regions in the most important point during the season. And farmers is a huge force in India, of course. So, maybe in order to avoid any further potential issues with supply, government might take a decision to keep higher stocks versus straightforward evaluations. In this case, there should be at least 2 tenders more until the end of the year. In any of those cases, there will be downward price correction. But if support comes from the second hypothetical tender somewhere in Q4, the magnitude will be less. Coming back to the news of last week, there were no fresh sales out of Northern Africa, but notional prices dropped to $475 to $80 FOB Egypt. European market is dead though. NCAC closed its tender for 5,000 tons of product on Thursday. We will know the results this week. Similarly, there were no fresh business out of Black Sea, so netback from Egyptian price suggests the level to be around $430 FOB. In the Middle East, producers were fully focused at upcoming tender and deprioritized any other business. Producers continue targeting around $500 FOB, but clearly there is no such price anymore. Notional offers slipped to $485 to $90 FOB level. Iranian producers finally had to accept the reality. For a long time, they were keeping target FOB level high, but this approach hasn't brought them any significant sales. Issues with massive shipments to Brazil and Turkey left them with little options. And as a result, they are facing now huge overstocking at ports. Some sources evaluate those close to 1 million tons, which now need to be cleared out. We should also take into account that summer temperatures plus humidity in the port warehouses result in quick product quality deterioration. Thus, I believe it was the main reason for Iranian suppliers to sharply decrease prices last week to $405 FOB. However, if it is enough to boost sales in such softening market, we will see the answer soon. Another clear sign of global price level decrease is the outcome of Indonesian pupuk sales tender last week. The producer offered again 45,000 tons for September shipment, same as in the tender scrapped last week. However, this time the bids were even lower, actually much lower, than a week ago. The highest was $455 FOB. A week ago, the producer scrapped the tender because of the low price versus its target, so let's see how it will act now, when the price is $20 lower. Brazilian spot market again was illiquid last week. Still, several sales were registered. And CFR level confirmed the global tendency. Price dropped to $460 to $70 CFR for non-Chinese material. US market was also subdued, with bearish sentiment prevailing for future business. Paper values in general supported the global mood, but moved a bit differently across the benchmarks. Egypt FOB slightly corrected downwards for both September and October. Arab Gulf FOB values remained unchanged because producers tried to maintain the level, as we discussed. Brazil CFR also dropped slightly for 2 months ahead. And NOL FOB again softened significantly by $15 for both September and October. Ammonium sulfate market remained slow last week, but prices stabilized. Chinese FOB copper price hovered around $160 CFR, and such level finally provoked interest from Indian buyers. There is different information circulating about exact amount purchased, but likely several vessels of 25 to 30,000 tons are heading to India. Also, Indonesian Pupuk entered the market with inquiry for 100,000 tons in 5 lots for October-November shipment. All these inquiries supported Chinese FOB price that slipped for many weeks already. Brazilian demand was still subdued, so CFR level was evaluated between $170 to low $180s for granular. Elsewhere, the liquidity was almost non-existing. Nitrates market was also very quiet, with demand largely subdued across the globe. Due to this, and also reflecting general market sentiment, prices softened, both for nitrate in Europe and UAN in Europe and US. In the ammonia market, the long-lasting bearish sentiment turned to bullish. September Tampa price surged by $53 to $540 CFR. This move pushed the Caribbean FOB price to $500. Also, it will guide global price level for the spot deals for the month ahead. However, exports from the US are healthy, as well as from Trinidad, where gas curtailments are not expected until second half of September. Supply from Algeria came back to the market. The producers sold about 40 to 45,000 tons on spot basis. The highest price achieved was evaluated at the level of $525 FOB. The key news of the week came from Saudi Arabia, where Ma'aden 1.1 million tons per year production unit was unexpectedly shut down, and the maintenance might take up to 2 months. It means that around 150 to 200,000 tons of product will be out of the market. Clearly, it will tighten the supply east of Suez. That was very long during past several months, despite the previous regular maintenance at Ma'aden. And even more than that, Indonesian Paranaya's turnaround will last longer than expected, which will add more pressure at the regional supply. In India, there were no fresh sales last week, but the buyers nervously expect the effect of supply decrease at regional prices. For now, inventories are evaluated as healthy, but it might quickly change if any contractual cargoes are affected by any unexpected disruption or so. In phosphate segment, there was little activity last week, and prices show signs of softening across the globe. In India, Hurl bought 50,000 tons of DAP from Russia at $809 CFR, which shows minimal but still downward correction versus price that was stable for weeks now. This sales shows the result of the tender that was extended by Hurl until August 26. Apart from that, no fresh spot sales took place last week. Ma'aden ammonia unit outage will not affect phosphate production, as per company's information. And this is important for India to maintain its contracted shipments. In Pakistan, the market is entering seasonal slowdown, and latest sales was conducted in the range of $800 to $820 CFR for 30,000 tons of cargo, down from previous level. Elsewhere in Asia, purchasing season also approaches its end, so importers' activity is decreasing, as well as their bids. News about additional export quota for Chinese producers that disturbed the market a week ago still haven't realized into actual sales due to wide gap between Chinese producers' offers and buyers' bids. DAP offers were in the range of $770 to $90 FOB last week, while buyers targeted about $15 to $20 less than that on the softening market. All eyes this week will be on the meeting of Modi and Xi Jinping, as it might end up with restoration of Chinese direct exports to India. Otherwise, it will be difficult for Chinese suppliers to sell out the additional volumes in other markets. Regarding Bangladesh tender results, there is still no clarity. Rumors circulate the DAP of Chinese origin was purchased at $848 CFR, but no confirmation for that. In Brazil, demand continues vanishing and prices soften. Last week, MAP was assessed at $725 to $35 CFR, but no fresh sales confirmed. However, market activity was focused at trading of Chinese NPs and NPS. In the US, the activity was minimal. Several DAP and MAP barges were sold around $790 per short ton FOB for September loading. Now the market is guessing what will be demand for fall, taking into account historically low affordability and limited supply options because of duties. Moving to the fundamentals. European natural gas futures fell more than 5% to 31.6 euros per megawatt hour, as weak demand enabled storage bills to outpace reduced Norwegian supply from maintenance. EU gas storage now stands at almost 77% of capacity. Softer Asian demand continues diverting LNG cargoes to Europe, helping offset Norwegian curves. At the same time, Russia shipped LNG to China from its sanctioned Arctic LNG 2 project, potentially reducing Chinese demand for global LNG supplies. Meanwhile, geopolitical risks remain in focus as Russian war against Ukraine continues without clear signals about potential ceasefire or peace. US natural gas futures, on the contrary, rose over $3 per MMBtu, supported by firming LNG feed gas flows and a below-average inventory build that reduced the storage surplus. Analysts noted that despite this week's rise, weather patterns over the next 2 weeks remain largely bearish, limiting further near-term gains. The tight storage levels, however, continue to underpin market sentiment, keeping prices supported. Overall, the combination of stronger exports and reduced inventories contributed to a bullish weekly performance. Agricultural commodities future prices were all in green zone last week. Wheat futures rose above $5.15 per bushel. Despite pressure from abundant Northern Hemisphere harvests and improved crop outlooks in Argentina and Australia, wheat prices still managed to gain. Russia has ramped up wheat exports after a slow start, shipping over 3 million tons in August, including large volumes to Egypt. In Poland, wet weather has lowered harvest quality, with 30% expected as feed grade. Yet a 5 million ton milling wheat export surplus is projected from a 13.5 million ton harvest. Strong demand for Polish feed wheat, such as a 55,000 tons shipment to Vietnam, shows lower grade supplies are moving. So looks like wheat prices found its floor and will move up a bit. Corn futures rose to more than $3.8 per bushel, rebounding from the lowest reached on August 12th, as ProFarmer's crop tour projected US output below USDA estimates, which added concerns over disease risks. The sense in the market was that market has pulled back from a phenomenal crop to just a big crop. However, it is still expected to be big. Storage will be a problem for the cash market to work through. Futures traders are moving past the crop size debate to focusing on demand. Fund managers believe that farmers will be forced to sell bushels at harvest that will let them out of their speculative short positions. At the same time, corn export demand remains strong. Soybean futures rebounded to over $10.35 per bushel after the USDA raised its rating of the US soybean crop. This surprised analysts who had expected slight declines. However, expectations of a bumper US harvest limited further price gains, even as traders remained cautious about weather conditions in the American Midwest. Market attention is also turning to Brazil's upcoming soybean harvest. At the same time, uncertainty over Chinese demand for US soybeans continues to weigh on sentiment. Many industry participants have become increasingly pessimistic about significant Chinese purchases this year amid escalating tensions between the US and China. Moving to the shipping industry. Containerized trade index hovered at the level similar to last week. Trans-Pacific spot rates declined by 3 to 5% last week, depending on the route. China to Europe rates also dropped by 6 to 10%. Despite healthy demand and port delays in Europe, a growing surplus of vessel capacity has been pushing down spot rates on this trade lane. Market experts' projection remains unchanged. Spot rates will continue declining further during this year. The Baltic Exchange Dry Index slightly rebounded last week. The Capesize market delivered a mixed yet broadly steady performance, with underlying demand offering support despite some midweek pressure on rates. For the Panamax market, it proved to be a muddling week, which started out positively for owners but ended less optimistically, mostly due to slowing of the business in Asia. For Ultra Supramax segment, it was a more positive week in the Atlantic. Stronger numbers were again seen from the US Gulf as prompt tonnage availability remained tight, and the South Atlantic also saw better demand. From Asia, it was a similarly stronger week, although as the weekend approached, market felt that demand might have been easing. In the Handysize segment, it was also a positive week, with rates firming across most loading regions. To sum up, Urea market held its breath in front of the Indian tender. However, general sentiment is bearish, and there is little hope that Indian price will hit even $500 CFR this time. There are many questions regarding the magnitude of downward price correction that still need to be answered, like how much impact will Chinese supply have in the Indian tender, and how many more tenders we should expect till the end of the year that might bring some support. Market also anticipates the outcome of Modi and Xi Jinping meeting this week that might shed more light on strategic cooperation of two countries. Ammonium sulfate price stabilized last week mainly due to supply decrease in China, but liquidity was still low. Ammonia price surged in the September Tampa contract, and bullish sentiment was supported also east of Suez amid unexpected shutdown of Ma'aden unit for at least 90 days. Phosphate price kept stable and even showed signs of certain softening as Asian markets approach purchasing season finalization and pressure for immediate shipments ease. At the same time, there is no clarity yet regarding supply out of China, and this uncertainty weighed on market sentiment. Natural gas price in Europe dropped due to weak demand, while price in the US, on the contrary, increased amid very healthy LNG flows. Agricultural commodities future prices rebounded more last week, mostly supported by activity of the traders. Container shipping rates continued downward correction, and bulk shipping activity revived, especially in Ultra, Supramax, and Handysize segments. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.